All right, everyone, thanks for coming to today's Lunch and Learn. First off, I would like to thank our sponsor, Straddling, for sponsoring the series and for their overall support of UCI Applied Innovation. Today's speaker is Tim Spangler. Tim is a partner at Deckard LLC and focuses his practice on the intersection of alternative investment management and financial technology innovations. He assists clients with the formation, structuring, and negotiation of private investment vehicles across numerous jurisdictions around the world. Dividing his time between the firm's Orange County and Silicon Valley offices, he also advises clients on the impact of blockchain, cryptocurrencies, and digital assets on the financial services industry and the innovation economy. Tim holds a BS in Applied Mathematics from UCLA, a JD from Vanderbilt University, and a PhD in law from the London School of Economics and Political Science. He is a frequent author and speaker on issues regarding developments in alternative investment funds and financial technology. Tim is here to give us an introduction to cryptocurrency funds. Welcome, Tim.
Thank you. Thank you very much. I want to start off by saying what a big fan I am of the Cove. I'm here quite a lot. I'm a member of Tech Coast Angels. I've sat in this room on both sides listening and to great information and great content and delivering some content which I'll leave it to you today to determine the quality and usefulness thereof. This is a tremendous resource that we have in Orange County that's so close to so much of what we're doing down here. So that's unsolicited and unrequested, but I just want to say I'm a big, big fan. I'm glad to see so many people take time out of their Friday. It is very cold, so I appreciate that people can't be as much at the beach or at the mall as they would otherwise want to be. I think the big thing to take away from my intro is, A, I'm a lawyer. And so I want you to either engage in or put aside any preconceived notions that you have about lawyers. I'm not the tech guy. I did my undergraduate degree in applied mathematics, which up until about 2 or 3 years ago was a lot less useful than it is now. I came through my legal practice for the last 24 years, focused primarily on investment funds, venture capital funds, hedge funds, private equity funds, and financial regulation as it covers all of those elements, from things as simple as, how to do an initial public offering, how to do a private placement, what sort of GP, general partner, limited partner issues arise when you're putting together a venture capital fund. That's really my basis. But of course, in anyone's life, you do a lot of different things. I mentioned earlier, I'm a member of Tech Coast Angels. I've been an angel. I've invested in startups. I've advised startups. I've done a lot of different things. But the reason we're here today is to talk, using that background of mine and my perspective on these issues, is to talk about cryptocurrencies and digital assets, specifically in the context of cryptocurrency funds, which are launching an increasing number. You hear a lot of reports. A number I used to say a lot was 174 cryptocurrency funds were launched in 2017. I heard it. It was a good number. I've been repeating it. I heard another number just earlier on this week saying there are 250 cryptocurrencies up and running that are actually up and running now. Again, I pass that on. Do your own research. What we do know is that, as with every single other asset class that has ever existed and will ever exist, there will be a group of individuals, a group of very talented men and women who have the ability to manage that money better, those assets better than the rank and file. And they will set themselves up as investment advisors or fund managers, and they will raise funds to trade in those assets. So we should be completely unsurprised. Our surprise level should be at 0.0, that we are now seeing this rise in cryptocurrency funds. Now, I know in an audience like this, we all come from a lot of different backgrounds, have a lot of different levels of expertise. So what I want to do is start off with a very kind of fundamental basic issue about crypto. And I'm going to gauge it in response to a couple of questions I'll ask in a few minutes. Then what I want to do is kind of put it in context for you. If you're going to be managing these assets, if you're going to be engaging in these sorts of activities, you do have to know not only what these assets really are, but also what the U.S. federal government and its many agencies and enforcement bureaus think as well. And I'll spend hopefully most of the time today, I'll fly through the first few slides, hopefully relatively quickly. I'll talk about some more pragmatic issues about launching cryptocurrency funds or investing in cryptocurrency funds, depending on what your particular background is. I know people are still coming in and still getting seated. I'll say one other bit of housekeeping work. I like talking. I also like listening and responding to questions. It also gives me a convenient time to go and have a sip of Diet 7-Up. So if you do have questions, I've been told that if you want your voice recorded for posterity, you have to stand at either one of the microphones. If you want to ask a question and not stand and not be recorded, throw your hand up in the air. I will have to repeat your words. I will usually use that as an opportunity to change the question you asked to the question I wish you asked. But I think I have that privilege standing up here under really, really bright beaming lights. My gating question, a couple of gating questions. Throw your hands high in the air, high and proud. Who here currently or in the past has ever owned crypto? Owned crypto. That's a good number. It is a good number. I'm going to guesstimate it's about half. I'm going to guesstimate it's about half. You'd be surprised how many presentations I give like this. And I'm full in front of rooms of lawyers and accountants, of investment bankers and broker-dealers, hedge fund managers, people at the upper echelons of our financial system. I gave and how few people put their hands in the air. I gave a lunch on a similar topic to this, 188 people, all sitting around in a big room. They're all financial professionals. Licensed, certified, working financial professionals. I asked that same question. This was a month ago. Out of 188 people, I had 4 hands in the air. One was the photographer, one was a busboy, and 2 people were sitting actually formally in the audience. So I'm still amazed about how disparate the intake of cryptocurrency is. This is, though, I know a few newbies in the audience, this is a group that is more familiar than many groups. So what I'm going to do is go relatively quickly through the overview and then really set my stall out when we talk about legal and regulatory framework. But I do want to encourage you, if any of you have any questions, to throw a hand in the air and let's try to address those as close in real time as we want. The Bitcoin origin story is one that you've all heard a lot about. Even if you don't own any Bitcoin, you listen to NPR, you read Time magazine, you have buddies that talk it up around you all the time. I think the most interesting thing about the origin story is when it happened. When it happened. The white paper was released in October 2008, just weeks after the collapse of Lehman Brothers. This was a time, and this is incredibly important, this is a time when the faith in the financial system was at an absolute historic low. People didn't know how many more banks would go under. If enough of them went under, what would happen to the Federal Reserve System? What would happen to BIS? What would happen to the international financial structure? What would happen to the U.S. government and the U.S. government's ability to interact? That was the thought, that was the reality that Satoshi Nakamoto, he, she, they, it, whoever that happened to have been, that was what was motivating them, and the early adopters as well. It's surprising, it only took a matter of several weeks from the time when the white paper was published till the Bitcoin protocol was launched and Bitcoins began trading. But remember that fear, and it was a very particular fear. It was a fear of intermediation. That's what Bitcoin was set up to address. That's what blockchain was set up to address, a fear of intermediation. You have an ability to transact without relying on someone in a trusted position that's going to stand between you and the other side of the transaction. There are a lot of Bitcoins. I think this is something now that people are more familiar with. It's not just Bitcoin. There are a lot of cryptocurrencies. We can rattle them off. That provides the ecosystem. That provides the underlying asset class that cryptocurrency funds are now attracted to. A lot of people thought, well, I can be a cryptocurrency fund. I know what I'll do. I will just buy and hold Bitcoin. That's all I'm going to do. I'm going to go to the beach. I'm going to learn French. I'm going to take up juggling. I'm going to do all this other stuff. All I'm going to do is buy and hold Bitcoin. We now live in a world where there are thousands of coins. There are hundreds of them that are very liquid and probably somewhat reputable. There's a much, much wider universe to invest in. And one of the things that regulators are dealing with now, and that you would have to deal with as you're launching your cryptocurrency fund or otherwise being active in the cryptocurrency space, is that there are so many coins, each coin has to be valued, each coin has to be reviewed, and an opinion formed one by one by one. There are certain generalities that we can make, obviously, about the cryptocurrency universe, but we want to be very, very careful and look at each and value each and measure each on their own merits. Blockchain is the technology behind crypto. It's very easy for me to explain blockchain. Blockchain is a chain of blocks, and the blocks contain data, and the chain gets longer over time as additional blocks of data are attached to the previous blocks of data. We can go into all sorts of computer architecture, we can go into all sorts of mathematical discussions about hash functions and the distance between prime numbers. It is just an incredibly important development in our ability to maintain information, transfer information, and communicate about information. The blockchain is fundamental to so much more beyond cryptocurrencies. I do believe it is important if you're going to be active in this area. You can be active at a very superficial level. People always say, well, I don't know how to fix an engine, but I can drive a car. I take that. But if you're going to be dedicating time and effort, your money and other people's money, I do recommend that you get at least a conversant understanding of the underlying technology behind blockchain. It is amazing. It will reward close study. It is fascinating. It is a tremendous development, and we're only now beginning to feel the implications as we apply it more and more widely. A couple of buzzwords: decentralized and distributed. Decentralized and distributed. It is very, very important to keep that in mind anytime you do anything around the space, and it's something that I've been spending a lot of time talking to the US regulators about. I've been in the SEC twice in February, 2 different occasions. I was invited in, there was no subpoena involved, to help our regulators better understand the technology. And it's always interesting in a conversation, you're sitting across from someone and they seem to know what they're talking about, and they're using all the right words, and you just assume people know what they're talking about when they're talking about a topic. And you hear them talking, and all of a sudden they'll say something, and you'll realize they don't get it. They don't get it. They still have in their back of their mind a paradigm or an image or some sort of schematic, and they're just defaulting back to it anytime they get pushed back. What so many people involved in the industry, relative newbies, and what a lot of regulators and many, many commentators fail to grasp is the power of decentralization and the power of distribution. What I realize in speaking to regulators and legislators and other people at the top of the tree from a governmental point of view, the point that I've been able to put that all down into, just a few words that resonates with people, and so I'll pass it on to you in case you need it. There is no 1-800 number. So many times you talk to people about blockchain and crypto and wallets and protocols and all of this, and they'll say, yeah, but we'll just do this. Well, we'll just do that. There's no customer service for the blockchain. There's no 1-800 Bitcoin. Well, there probably is, but it's probably not people who are going to help you. The hardest thing for people coming into this space, and the hardest thing for people who will be regulating this space, is keeping in mind this concept that it is a decentralized, distributed system. I've included a very, very basic slide here on how blockchain works. It will be very familiar, given the caliber of people in this room, to most people. It is a process. It is a very, very important process by which information is registered, grouped together, time-stamped, encrypted, and linked together to the information that came before. Distributed ledger technologies. It doesn't roll off the tongue, but it's important to remember that anytime we're using blockchain, we're just saying we have found a new way of keeping and maintaining records, keeping track of data. In Bitcoin, in Ether, and cryptocurrencies, what we're keeping track of is ownership. Keeping track of transactions, but we can work back through a series of transactions to prove ownership. It is a way of processing information that relies on this powerful technology of blockchain. There are others. I'm not an investor, but this is one. There are different ways of connecting information. Blockchain is one. There are different ways, and there will continue to be innovation in the way that information is maintained on a distributed ledger, on a distributed decentralized network. I want to say a little bit about mining and a little bit about coin generation, because if you're going to be investing in these coins, if you're going to be managing money that invests in these coins, if you're going to be interacting with state and federal regulators about what you do, it is important to get the framework right. Now, I meet a lot of people who have what I call the NPR understanding, National Public Radio understanding of mining. You've heard it so often. You could repeat it in a full paragraph. What do miners do? Miners are the people who use hardware to solve complicated mathematical problems. For solving those problems, they are rewarded with Bitcoin. It's just they cut and paste it into the scripts, into the articles, they cut and paste it. It's not that it's wrong, it's just not right. It's just not complete. Miners form a very, very important function. There are, I believe this is the last number I heard, 200,000 full nodes on the Bitcoin blockchain. Those are all full copies of the blockchain, a record of every single transaction that has ever happened since January 2009. And what the miners do is process transactions. I want to bet you on the next Lakers game. I'm a big Lakers fan. It's hard, but I'm going to bet on Lakers to win. They lose. I owe you money. I have to send you a Bitcoin. I'm a bit of a baller. I play large. I bet Bitcoin, straight Bitcoin. A putt, a basketball game, doesn't matter. I'm betting a whole Bitcoin. Now, that transaction has to be processed. And what the miners do, again, I don't want to take time away from people here who know more about this than I do, but just to make sure that we're all on a level playing field. The miners are those people who are using their rigs, who are using their ASIC machines to process transactions, build a block, about 2,000 transactions, takes about 10 minutes to build a block, prove the block, put it on the blockchain, and have it verified. That's what the miners do. When you buy something from Amazon, when you go onto Facebook to update your status, there is a server. I know there are many, but indulge me. There is one Amazon server. There is one Facebook server. And it's plugged in. Let's take Facebook. The one Facebook server is plugged into Mark Zuckerberg's office. Who pays for that server? Mark Zuckerberg. It's his server. He owns it. He paid for the hardware. He runs the software, and he pays for the power. When you use Facebook, when you order something off Amazon, that cost of operating that centralized network, you're paying for, directly or indirectly. Oh, I don't write a check to Facebook. Facebook gets a lot more value from you than you get from Facebook. That's why it's worth hundreds of billions of dollars. On a decentralized, distributed computing network, who's paying those power bills? If you're a student at a university and it's plugged into your dorm room wall outlet, no one, or at least not you. But generally speaking, anyone who's going to be a node on the blockchain, anyone who's going to help this blockchain exist is going to have to cover their costs. Mining is a way to remunerate the distributed nodes on the network. Very, very important. That's the introduction. So that's the outline. Now I want to take a breather. I need a sip of Diet 7-Up. And I want to give anyone in the room who has a question that they want to know, just so we can level set and make sure everyone's here is on a level playing field. Any questions about the technical structure or background of blockchain? Don't be, oh, there's always one. We got two. Right over there, Young.
As you said originally,
At the microphone, if you can, if it's near you,
as you said in 2008,
Is it on?
Is it on? On?
Oh.
I'm sorry. I need to almost step on the feet. In 2008, the paper was arguing for the cryptocurrency because of distribution.
Yes.
But what we have today, only few miners, because the operations are becoming so costly that the mining operations are concentrated in China. What is your perspective?
You can always rely on the Central Committee and Politburo of the Chinese Communist Party to really come in and solve problems when they need solving. And this was a huge issue last year. We actually, and I'm not a technician, but I can listen to conversations that technical people have and not get entirely lost. It was a real issue. Fortunately, though, as it stands now, mining and onshore exchanges and offshore exchanges, the entire crypto industry has been criminalized by the Chinese Communist Party. A task they're good at. They've got track record in this. They can actually do this and do it well, criminalizing things. So what I've heard is upstate New York, I've heard Canada, I've heard people are going to launch rigs into space. There will be solutions. I do think the mathematics behind capture and the ability to force consensus, I think it's real risk. We have to be mindful. These are the products of human hands. They're subject to all the flaws that we have, all the need for improvement, that anything we've ever done in the human history will need to be improved. My view is we have to be mindful. My view is we have to be attentive. And it is so incredibly easy to launch new coins. If we do need to fix things like that, hopefully there will be bright people. I'm sure there's someone in this audience who's going to do something like that in the near future. We'll be able to come up and craft a technical solution for that. But that's where it's important to understand the underlying technology. If you're just thinking about Lambos and, oh, I had a 16,000% return, you got to know the technology. You've got to understand the technology so you can include that in the investment decisions you're making for clients.
Question. Is blockchain going to be suffocated pretty soon because of the large database? And the upcoming technologies that can kill it easily. Like to have your opinion and feedback into the new technologies. Thank you.
Yeah, creative destruction. Creative destruction. We will see, this is not the end of technical evolution. As amazing as blockchain is, we don't want to make the mistake that the director of the Office of U.S. Patents made in 1898 when he sent a memo to the president saying we should close the patent office. Everything has been invented. There's just no need. We've got everything. Look around. What hasn't been invented? Yeah. There will continue to be evolution. I'm more concerned about quantum computing than anything else that I've been told about. There will be technologies that challenge blockchain. That's another way of saying there'll be developments by which the blockchain technology will be improved. As of now, personally, from the projects I'm involved in and things I know, I'm fairly comfortable with the resilience of the existing blockchain technology, given the amount of time that it would take to hack the blockchain. The mathematics behind the current configuration of Bitcoin gives me some level of comfort, but there will be technological challenges, and that will create opportunities for new technologies to come in.
So it looks like this is going to be actually part of your next topic, but there was an article in the Wall Street Journal yesterday about the SEC probes,
Yes.
investigations. That was one, and then there's also an Ernst & Young report that talked about the blockchain, and one of the things they concluded was that the tokens really aren't necessary to have a good blockchain.
Yeah, those are both good questions. I will be talking very much about the SEC probe, so if you can give me a few minutes on that. You don't need tokens to have a blockchain. A blockchain, distributed ledger technology, can be used for many, many, many different things. If it's a public blockchain or a private blockchain, there's that difference we can start making between public blockchains and private blockchains. You can use a blockchain for the Internet of Things. You can use a blockchain for clearing and settling of securities, land titles, car titles, logistics, supply chain. There are so many uses for blockchain. I hear a lot And I could make a lot of money if I just had a little stall and afterwards I could sell the t-shirts and the hats that say, it's not Bitcoin, it's blockchain. I hear that a lot, always with a smirk. Always like over a dinner party or someone knows, oh, you're in that Bitcoin stuff. You know, it's not Bitcoin, it's blockchain. Well, fine, but Bitcoin is blockchain. Bitcoin is under persistent, continual attack. We know that blockchain works because how many people know what a bug bounty is? How many people have heard the phrase bug bounty? That's where I have a piece of software. I talk like I know what I do, programming. I talk like a coder. That's where I have a piece of software and I put it up there and I say I will pay a bounty of X dollars if someone can bug this, can hack this, can break this. What's the current market value of Bitcoin? Hundreds of billions of dollars. We have a hundreds of billions of dollar bug bounty out there on the Bitcoin blockchain. It is subject to continual brute force attacks. I just see the effort people take to call from foreign countries my parents in Anaheim and try to scam them. That's human effort. People are trying to scam my parents out of a few $100s. Imagine the human capital, the mental and technological firepower that's being thrown at the Bitcoin blockchain every nanosecond. We can do a lot of different things and we'll do a lot of different things with blockchain, but let's not underestimate the proof case that has been made by Bitcoin. One last question and then we'll go into some more substance.
Yeah, just want to bring it back to one of the slides you had there about the DAG, the DAG.
Oh.
I'm just really curious because it's, I think if I read it correctly, it said infinite scalability. And I know some of the issues that blockchain and Ethereum have are scalability issues, so just curious about the buzz, like why isn't it talked about more?
It should be. I don't want to, they say it's infinitely scalable, so why can't we believe them? All I put this up there, I really wanted to preface it by saying I'm not backing this, I don't want to make any claims to it. I just like it because it's an interesting graphic. It's like, oh wow. And they call it a tangle, and the abbreviation is DAG. Which has a meaning in English vernacular. I just wanted to put up there that even when we're talking about blockchain, we're talking about a species of a wider genus. The genus is probably distributed ledger technology. Blockchain is one implementation of it. There are many, many other things we can do to try to link information together in a decentralized, distributed way. I just want to add one thing to this whole issue of it's not coins and tokens, it's blockchain, and you can have one without the other. Of course you can, but it still raises the question that I raised earlier about mining. And I won't go back to that slide, but if you're going to have a decentralized distributed system that does anything, and it's going to be public, someone's got to pay for that hardware. You've got to convince someone to switch over from mining Monero or Neo or Bitcoin or whatever. You've got to get them to put their rig on your blockchain. They have to be incentivized to do that. We have to get value to them. How are we going to get value to them unless there's some sort of digital asset, some sort of native digital currency that allows that person to pay for the rig and pay for the electricity, and hopefully have some money left over for beer, or rent, or some reason to be doing it. We have to incentivize the miners in order for the blockchain to actually physically operate. Now, if you have a private blockchain, then it's like the big, massive Facebook server in the corner of Mark Zuckerberg's office. He just pays for that. He just pays for that. So understand the architecture will help understand questions like that. Now, I know there probably aren't any lawyers in the office other than me, because lawyers are at their office probably billing you in 6-minute increments for the work they're doing for your startup companies and your financial service firms and otherwise. But if there are, any lawyers in the audience can ask me any more detailed questions that they wish. There was this crazy case from 1946, and every law student who takes corporation law or securities law in any of our 185 fine ABA accredited law schools in the country for the last 50 years always learned about this case, and it was a Howey case. And any lawyer, any law school student who's taken that class, you can mention it to them, and they'll all remember it, because it was a wacky case. The narrow question it was trying to answer was this. When is something a security? When is something a security? I know a stock is a security, I know a bond is a security, but what other types of arrangements are securities? Now, if you were following like the stock market price of the Howey case, it's been bopping around the floor for the last few decades, bopping down, bopping down. The kind of the value of the case now, kind of from an eyeball tracking, shot way up over the last 2 years because obviously people realize that the U.S. Supreme Court has actually opined on the very question of whether something like a digital asset is actually a security. Something like a cryptocurrency coin is actually an asset. The case, and I'll give you a 30-second view of it, the case involved orange groves in Florida. For those of you who are native Californians, Southern Californians like me, you always have to remind yourself that it's not always 78 degrees in February. It oftentimes gets cold in the Northeast, and when people in the Northeast get cold, they go to Florida. It's their decision. It's a free country. They can go if they want. And at this time, in the 1940s, people would come down to Florida, stay at a hotel, enjoy croquet and lawn tennis and walking on the beach, whatever people in the 1940s did on their vacations in Florida. And they would stay at hotels, and there was a particular hotel right down the road from a vast orange orchard. And there'd be signs, and people who worked for the hotel would tell people, you know, since you're here, came all the way down from Philadelphia or Boston or wherever you came from, you know there's a phenomenal orchard just down the road. You should go and look at it. They've got some interesting things going on down there. So you go down there and you have a conversation with Mr. Howey. He gets his name on a Supreme Court case, so it didn't end that badly for him. You talk to Mr. Howey, and Mr. Howey tells you this. You like orchards, it's beautiful. You know, we make a lot of money on these trees. We make a lot of money on these trees. I'll tell you what I'll do. You, Mr. Northerner, Ms. Northerner, coming down for our sunshine. I will sell you a fragment, a part of an acre. Units, I believe, of 42 trees. That was the unit, one full row. I'll sell you 1 row, I'll sell you 7 rows, I'll sell you 20 rows of trees. You will own these trees in fee simple. You will have a warranty deed. These will be your deeds. These will be your trees. And you're like, great, but I live 1,000 miles away. I can't drive down here every weekend to spray the trees and pick the oranges and pack them out. And Mr. Howey thought about that. And Mr. Howey said, don't worry. I will sell you the trees, and then I will sign a management contract with you. And pursuant to that management contract, I'll spray the trees and water them and pick the fruit and box them and ship them out. And I'll get money for them, and I'll send you a bit of the money every year. SEC said that's a security. Lower court said no, it's not a security. Appeals court said no, not a security. Supreme Court case looked at it and said, yes, it's a security. And they adopted the so-called Howey Test. Now, I will show you that the Howey Test has 4 prongs. 4 prongs. Everyone you ask about the Howey Test who went to law school, who was taught it, I've taught the Howey Test right around the corner here at UCI. 4 prongs. Go onto the SEC website. Look at the ruminations, speeches of SEC Chairman Jay Clayton. Fine man, fine man. For some reason, it now has 3 prongs. And I'll tell you the prong that seems to have gone walkabout, seems to have gone missing. But this is the analysis that the SEC goes through, that courts go through, when they have to decide, is your token a security? Is that collection of arrangements and schemes that you've entered into, is that a security or is it not? First thing you need is an investment of money. First thing you need is an investment of money. Money goes from person A to person B. Person A to person B. What's a very common feature of the cryptocurrency universe that gets around this first prong? Shout it out. No? No, but this one, an investment of money. What common thing happens? Close. Airdrop. Airdrop. When you just give someone something, donation they'll look through. Donation they look through. It's easy. The SEC can pick that apart. If I airdrop a token, where's the investment of money? The SEC has a counter argument to that. I have a counter argument. But that's the first prong. If you're taking money from someone, you've just checked with a big red pen, you've just checked box 1. So don't even think about it. Don't even try to unpack it. You've taken money from someone, you've checked factor 1. Factor 2, common enterprise. Factor 1, common enterprise. This is the factor that the SEC has misplaced. They've forgotten about this. They wrap it into others. I suggest to you it is an incredibly important factor. And I don't think that the motivations of the SEC are malign. I think they've read the case as much as anyone, generally speaking, has read it. I read the case every Monday morning. I have it on my hard drive. It takes me about 15, 20 minutes. I read the case every Monday morning. This is important, and I think this gives us, as an industry, some hope for the future. Hope for the future. As regulatory interpretations get refined, we can focus on what is or is not a common enterprise. Solely from the efforts of others. If you take money from someone and say, here's my coin, here's my token, I'm going to build you the most amazing blank. I'm going to build and this is where you pick an existing centralized service, you throw blockchain in front of it, and that's your new startup. We're back in pets.com and webvan land. I'm going to build a decentralized Facebook. I'm going to build a blockchain Amazon. I'm going to build a distributed Tinder, whatever. Solely from the efforts of others. If you're taking money for something that does not yet exist, and you're saying, check back with me, kids, in about 6 months, we're going to have the most amazing system up and running, you are using your efforts to do something for the benefit of the investor. You will be in factor 3. My favorite word, who wants to guess, who wants to shout out what my favorite word in factor 3 is? Which of those 2, 4, 6 words is my personal favorite word? Solely. I can think a lot about solely. For something to be solely the efforts of others, not me, that means I can't make any effort whatsoever. If I make any sort of effort, the resulting product, process, can't be solely from others. Oh, I'm responsible for 1% of the effort, 0.5% of the effort, 0.0002% of the effort. What can we do with this factor in the months and years to come as we try to navigate this? Factor 4, with a reasonable expectation of profits. We heard the shout out for donations early on. If it really is a donation, like you're not expecting a tote bag, like when you donate to public radio, maybe there's scope, it's just not nearly as big as people think it is. Using the whole donation front, but we might give you something back in the future. They actually look at reasonable expectation of profits, and I say they, I mean the SEC. They look at it both in terms of profit on the initial investment and the value of that token increasing over time. So you can say, I'm never paying dividends. I'm never paying distributions, ever. You give me the money, you're not ever getting a dime back from me. I'm forswearing any sort of cash flow going from my pocket as a recipient of those ICO proceeds. I'm not going to hand any of that money back. The SEC sees, though, the value of the increase of the price of the coins as actually fulfilling factor 4 as well. Now, many of you know ICOs. I don't want to spend a lot of time going through this slide. ICOs are a very important technological development built on smart contracts, built on the power of smart contracts to translate commercial arrangements and potentially legal arrangements into code. I want to talk about a couple of other regulators, and then I'll draw a line under this segment of the presentation. The CFTC came in hot. They came in early. They said, well, I'm not going to wait for the SEC down there in DC to opine. We CFTC people in Chicago, we see Bitcoin and all digital assets as being commodities. So if you have a derivative contract based on the value of a commodity, you're subject to CFTC jurisdiction. If you try to manipulate commodities, you're subject to CFTC jurisdiction. If you want to really understand the power of CFTC, the reach of the CFC jurisdiction in a very concrete way, who's a fan of the film Trading Places? The last 30 minutes of Trading Places will walk you exactly through commodity manipulation and the jurisdiction of the CFTC to send people to jail for that. So most people will say, kind of close out the Howey and now this, most people will say the SEC's position, because they've not opined on whether Bitcoin is a security, most people believe that the SEC feel that it's not a security. A pure crypto, not a security. All cryptos are commodities, though. All cryptos are commodities. So if you manipulate the price of a Bitcoin or another non-security crypto, you could say, well, the SEC can't get me. Fine. They'll find, if they want you, they'll find a way to get you. You are still under the authority of the CFTC. So if you're going to be trading in crypto, understand that the SEC is an entity that has to be answered to, and the CFTC. So the CFTC came in 2015. Which government agency came out first and stated their opinion about crypto? The IRS. God bless them, everyone. The IRS, it only took them a couple of years. And they came out and they said that absolutely, definitely, crypto is subject to tax. It's taxed as property. The bad result of it being treated as property is the following. You convert fiat into crypto, not a taxable event. Not a taxable event. You had $100, you bought $100 worth of crypto. The crypto goes up in value. A year later, it's worth $1,000, your crypto. You sell it for cash, fiat. Taxable or not taxable event? Taxable event. Yeah, I've converted it into cash. And also they can find it. They know it's been converted into cash because I have to put that cash somewhere and the IRS could find it. I take my crypto A and I exchange it for crypto B. Taxable or not taxable? Taxable. A lot of people didn't realize that. But if you look back on how the SEC treats property, if you take your favorite baseball card of Joe DiMaggio, it's worth a couple $100,000 now, you trade it to someone and you get a house in exchange for it. Taxable event. You're converting one form of property into another form of property. People who flip houses, this is Orange County, I'm sure everyone here is flipping houses. This is Orange County, this is what we do. You realize that there are tax structures, tax-free exchange. There are things you can do when you convert property into another property. But it is subject to the full length and breadth and depths of IRS rules and jurisdictions. Before I go into really the meat of the presentation, what we're seeing in the world of cryptocurrency funds, does anyone have any questions about the general point of regulation? If you can, just go to a mic if you do. Any questions about the legal or regulatory position that our government is taking?
Yes. What is your justification of giving the cryptocurrency assigning as a commodity? My view of cryptocurrency is nothing. It's void, empty, just few bars and code. But what is their justification?
Their justification is a statute that gives them the power to call things commodities. And they get a salary, and they have an office building, and they get pensions. So that's what they do. What are commodities? Commodities, remember Trading Places. Remember the scene in Trading Places. What's commodity? Orange juice, bacon, pig bellies. Anything that can be traded is arguably, potentially a commodity. And what the CFTC has based on what happened with derivatives and swaps in the 80s, 90s, and 2000s, is where it's a financial commodity, there's a very, very broad power to call things, just say, that's a commodity. You know, chicken pizza, commodity. They've got this much, much broader power to do that. Because if you can write a derivative on it, then by manipulating the underlying commodity, you can be manipulating the derivatives market, which they're responsible for. So because we can manipulate, like they did in Trading Places, we can manipulate the market for orange juice. We can manipulate the derivative markets that sit on top of it. So it was anticipatory. They didn't have futures contracts or derivatives trading at the time the CFTC opined. But it was basically putting a chip on the table. I would say if you have to pick your poison, if you want to be regulated by someone, do you want to be regulated by the CFTC or the SEC? He got meme famous, the chairman of CFTC, meme famous a couple of weeks ago when he testified in front of the U.S. Senate Banking Committee. You know what he didn't say? He didn't say it's all a pile of stinking crapola. He didn't say, oh, it's a haven for fraudsters. The CFTC's chair didn't say, we should walk it off to a cliff and push it over, this whole crypto community. You know what he said? He said, all right. We've seen stuff more volatile. You want to start trading embedded VIX options? Boom! You're all over the shop. The SEC, on the other hand, is a little bit more nervous. Well, they're a lot more nervous. And so you have this disparate approach. I actually think in the battle for jurisdictions, if we could vote, it's got to be regulated by someone. Probably the CFTC is going to be a more generous, accommodating regulator than the SEC. I think the SEC will get there. I'm trying to help them however I can. But they have their jurisdiction and they're willing to enforce it. One last question.
Sure. A comment and a question. Comment first. Lightning Network will handle most of the Bitcoin scalability and performance issue. My question regarding the Howey Test is if an ICO is done and where the product is already done and their customers, does that still make it a security or not?
Right. I'm glad to, we have 100% guarantee on the functionality of the Lightning Network. If anything ever happens to the Lightning Network, you can find this human. He will refund you transaction costs. I hope Lightning Network works. Nothing has to work. Nothing has. People are really excited about it. People who know more than I knew are excited about it. But it is a different protocol that's being set on a different underlying technology. So let's see. I'm as optimistic as anyone. You have to be in the country we live in today. So we have to be optimistic. We're going to be optimistic. Lightning Network will work. There's this concept of a utility token. The SEC didn't create that. The SEC didn't wake up in the middle of the night collectively and said, I know what we're going to do. We're going to create this concept of a utility token, and that's going to be outside of SEC jurisdiction. You know who created the concept of utility token? We did. We did. Reddit did. We got to trust Reddit. People actually in the industry were trying to navigate this in their head, and they created this concept of utility token. Well, if it has a utility, it can't be a security. If you have day one utility on a network that already exists, and you're giving value for a service that is immediately enjoyable, it all exists now, you can make the argument that you're a utility token. That is very, very, very few ICOs. There are some ICOs that do that. If you have an up and running technology, you would be giving money for an actual service that can be rendered now, not in a week, a month, or a year. I think there's still some very, very good arguments that can be made for ICOs that are utility tokens, and I make them regularly. I'm really proud of the arguments I make there. But it is a much, much smaller target than people would have said 3 months ago or 9 months ago, and that it was a very, very big, broad target. Now let's start finishing up our presentation with some information for you about cryptocurrency funds. They're not a new thing. The first one, Pantera Capital, launched in 2013. Surprisingly, there weren't that many after that until 2017. It was really about the middle of 2017 that you saw a huge uptick in the number and size of cryptocurrency funds. Obviously, it was linked to the steep increase in the value of Bitcoin and the general widespread media coverage of Bitcoin that a lot of people can remember really taking off in June and July of last year. In addition to the media coverage, there was this gold rush mentality. Got to get in. Got to get in. Got to get me some of that Bitcoin. There was another factor that led to the rise of cryptocurrency funds in the middle of last year, and that's Bitcoin holders' desire to diversify. Even true believers, even early adopters were seeing their $1,000 Bitcoin going up to $5,000, seeing huge increases of value. Even if they just bought in a couple of months earlier, they're seeing this huge increase in value. And with the launch of so many other currencies, a willingness to back bright young men and women who said, I'm going to launch a cryptocurrency fund that's going to invest across a whole stretch of different currencies. What do cryptocurrency funds do? So you decide after this, I'm an engaging speaker, kind of pumping people up. You walk out in the parking lot right after this and say, I'm going to launch my own cryptocurrency fund. What does that mean? What does that mean? I mentioned earlier before my presentation, some are just buy and hold. Some are just buy and hold. As I said earlier, you can just say, my cryptocurrency fund is just Bitcoin. I'm going to go out and surf or rollerblade or whatever kids do nowadays. That's not really that much of a value add anymore. With the rise of Coinbase, with the rise of the Bitcoin Investment Trust, there are ways for civilians to be able to put their money into crypto now that are quite easy. I think number two is incredibly exciting now. The capturing of arbitrage opportunities. We're seeing a real wave, and I'm glad to be involved in some of these, a real wave of algorithmic trading and the porting over into crypto of trading technologies and trading strategies that have been tested and proved over the years in traditional financial markets, what we would call fiat markets. Does your cryptocurrency fund invest in ICOs, either pre-sale or in the general sale? Is this something that your fund's going to do, where you're going to pick winners of the new coins that are issued and not just trade in existing coins? Will you invest more broadly? Do you have a fund that invests in fiat and in crypto? It's always priced in pairs. It's always priced in pairs. Maybe you see the South Korean won Bitcoin price going in one direction. You see the Canadian dollar Bitcoin price going in another. Maybe you're not just investing fiat and crypto. Maybe you're actually putting money into the companies, the real three-dimensional existing companies that are making money providing the infrastructure and the services to that. Do you invest in Overstock.com? That was a big proxy up until their recent SEC filings, where they say the SEC's asking them some complicated questions about their Bitcoin and crypto exposure. Do you invest in the hardware companies that are making the ASIC machines and the rigs that are powering the miners in the blockchain? What will your cryptocurrency actually invest in? That's good money. That's good money. It's the axis of Bitcoin evil. You've got Russia, you've got Venezuela, you've got all these other people. You've got all these other people. We're limited only by our imagination, and that is one of the most frightening phrases you can ever keep in your mind. Who knows where this all is going to end? What we've been doing in my space over the last couple of years is adapting traditional hedge fund document, private equity, venture capital fund document to adapt to the world of crypto. And it really does depend on what your particular cryptocurrency fund may do. Remember that the federal securities laws continue to apply. And remember that most likely, unless you're very, very precise about what you'll be investing in, one of your tokens will be a security. One. You're away on vacation, you leave your trading algorithm in your cousin's hands, he accidentally lets one security token sneak into the portfolio, you're trading securities. It is the one poison grain in the silo theory. So I stress to people, when you're moving into this space, the time for, if there was a time for linguistic acrobatics around these issues, it was 2015, 2016. That time is not now. Be prepared for full security law compliance with what you do. Understand the technology. If you're going to be embedding your trading strategy or your approach to investing in technology, understand that technology and how that works. I'll go through these last slides fairly quickly. I do want hands in the air. If anyone does have any questions, I want to make sure that people can air them. What we're mostly seeing, question here. Yeah. And if you do have a question, just go over to the microphone and I'll point out to you. Yeah.
So you're talking about how if there was any security token that ended up in a portfolio, that could be a sort of a poison pill type of thing. Has there been any actions yet by the SEC where they followed up on something post-ICO that could end up in a portfolio like that?
Oh, absolutely. The news report in the Wall Street Journal, this has been going on for weeks, but it finally got an intrepid 26-year-old reporter's attention. I don't know who it was, a couple days ago. The SEC is sending out subpoenas asking for information about a whole raft of ICOs that have taken place in the last several months. And really, I don't see this development. Yesterday, I got called by a lot of people about it earlier in the week when it first posted online. I don't see this increase in SEC activity as moving the needle. The needle's still where it's been for the last couple of months. What I do see this is really just showing that the SEC will put resources behind it, human capital. If you have done an ICO and you tick the 4 boxes of the Howey Test, or sorry, there are only 3 now. There are only 3 now, according to the SEC. Expect a phone call. Expect a phone call. The SEC is going to go out fairly comprehensively. This is what the SEC does, and police these ICOs. If you got your ICO wrong, you've given your investors, just to realize the magnitude of what's at stake. When you blow the Howey Test, when you become a security and you did not do a valid private placement and you did not register that public offering with the SEC, you've given each and every one of your investors a money-back guarantee. Guaranteed by who? Guaranteed by you. You have guaranteed them every cent on the dollar. The great thing about investing, other people's money, I can take, if the legal documents are well drafted by a lawyer of my quality, I can take money from a client, and there's nothing duplicitous about this. You give money to me as your investment manager. I put all of your money in horrible investments. I mean, like, I'm investing in, like, Madonna films, like motion pictures starring Madonna, just horrible investments. I lose all of your money, or nearly all of your money. I send you back a letter saying, you gave me $1 million, here's $75.28, it's all that's left. I'm really, really sorry. My forwarding address is in Chamonix. I'm going to be skiing for the season, and then we'll figure out what I do after that. But here's your $75.28. Does the investor have any claim of action against me? No. No, I can lose people's money. You can lose people's money as long as you haven't defrauded them, as long as you haven't lied to them, as long as you haven't breached federal securities law. If you've breached federal securities law in the issuance of your ICO token, you are in, like, big trouble. Like, big trouble. And it's never too early to start getting your head around that liability exposure. It is an important point. The SEC is moving, and they're going to continue to move, and they're going to continue to move hard in this area. The types of funds we are mostly setting up for people are open-ended hedge funds. These are funds that tend to be mimicking hedge funds in that they're trading funds. Buy and sell, buy and sell, buy and sell. Delaware limited partnerships, Cayman limited companies, very, very traditional hedge fund approach. We've had this structure for 50+ years. Customary fee structure in hedge fund land is 2 and 20. The performance fee, as you hit particular return targets, the performance fee, the 20 in cryptocurrency funds, I've seen as high as 40. And I believe there's a 45 that's going on market. 45% of the profits will be going to you. Wow, what are we all doing here? We got to go. We got to set these funds up. There will continue to be evolution in structures as more managers do different things with their investment strategy. But it's important to remember that we do have documents, we do have structures, we do have approaches that are regulatorily compliant, that help you mitigate your legal liability as a manager, as someone who can be sued. We make sure to the greatest extent that we can that we protect you. We protect you by putting in lots of disclosure, lots of risk factors. I say in my first meeting with clients who are setting up funds, any type of funds. You know, there's a I read in your bio, I'll say this to someone, I read in your bio that you graduated from Harvard University. And I'll say to them, you know, from the SEC's point of view, there's a big difference between graduated from Harvard University and attended Harvard University or visited Harvard University. What you disclose in your documents has to be true and correct. No material misstatement or omission. Be very, very careful when you're drafting your disclosure documents around your cryptocurrency funds that you're talking about the technological risks, the hacking risks, the quantum computing risks. Make sure that you're talking about the regulatory risks, the investment risks, liquidity, volatility, valuation. It's okay to lose money for your investors. That in itself shouldn't give rise to legal liability. But if you've lied to them in the PPM, if you've misstated things in the PPM, if you've given them incorrect information, they will say that the loss was linked to the misdisclosure. Somehow the collapse in your trading strategy was linked to the fact that you attended Harvard but didn't graduate from Harvard, that you didn't disclose this particular type of technological or hacking risk. I'll close off in the next few seconds going through these slides a little bit more quickly. It's very important to have good service providers. I'm sure many of you have settled on your lawyer for launching your cryptocurrency fund now. That's great. So I won't talk about law firms at all. Auditors are incredibly important. It's very, very important to have auditors in place who understand the asset class and that you understand what you're buying, what service you're buying from the auditors. What are they actually going to do to prove that your financial statements are correct, that you've represented to your participants, your investors, that you actually hold what you hold. Unique aspects of audits. We have to determine that the digital assets exist. We have to be able to demonstrate that they're your digital assets. How does an auditor come in and demonstrate control and then custody? How do we custody these assets? One of the first things I said the first minute I stood up here. This is an infrastructure. This is an ecosystem that is not meant to be intermediated. How do you intermediate someone? How do you put a custodian into this structure? When the SEC is requiring for registered investment advisors, for big investment advisors, mandating that there be some sort of qualified custodian involved here. How do we include that? The custody issues are real. If you're going to be trading digital assets and you're going to have clients whose money you're trading, you have to think about the custody issue. You appoint a qualified custodian, someone who's a broker or a bank or a foreign financial institution that historically holds investments and securities on behalf of others. What do you give them? How do they demonstrate that they're actually having custody? Is it a hot wallet? Is it a cold wallet? What do you give them? I've grouped these issues together in 3 different categories, and then it's the end of my presentation. I'll take any questions that people have. You have to think pre-trade about your decision-making process. What are you going to be investing in? How are you going to be investing in it? How are you going to be making those decisions? If I'm investing in Bolivian mining companies or Japanese high-yield securities, I will have research analysts on site who help me find out information about the various verticals that I want to invest in. If you're going to be launching a cryptocurrency fund and investing in crypto, you should have scientists, data scientists on site, on your payroll, who actually understand blockchain technology, who actually understand cryptography. It's not just about opening up CoinMarketCap and saying, well, they're red, I'll buy. They're green, I made a good decision yesterday when I bought at the red price. Make sure that you have the personnel available that understands what's actually going on with the currencies. Execution, there's so many execution options available today, exchanges, OTC, post-trade issues. Once you have your beautiful crypto, your lovely, gorgeous, magical crypto, how do you make sure that you will keep having it in the future? Storage, hot wallets, cold wallets, understanding how you integrate your trading strategy into your custody strategy. How do you hold it so you can keep holding it? All very, very important decisions. Those are my prepared remarks. What I will say is this is my exit thought, and then I'll take questions from the floor or individually. It's a very exciting era. I'm a true believer. I have to say I'm a true believer about the power of blockchain. We got a lot wrong with Internet 2.0. If you're like me, sometimes you just lean your head back in a quiet moment and you think, yeah, Amazon, Facebook, Google, just doesn't feel right. It doesn't feel right. It feels kind of matrixy. It doesn't feel like that was the universe we were about to enter into. It just doesn't to me. The more you think about it, this massive centralization just kind of doesn't feel like what we were all happy about in the early 90s, sing-songing, Mother Jones reading, it was great, it was crazy, the whole Earth catalog, wow, it's going to be amazing. You can think about blockchain as Internet 3.0. It's very rare that we get a do-over. We're being given a do-over now. We can fix the internet, but we have to fix it by coding it. We have to code our way out of the problems that we face now on the internet, and that can and should be blockchain. So if anyone has any questions, please come up to the mic. I'm glad to take public questions. If not, thank you very much for your time. I'll here to answer private questions if you have them. All right.
Very good presentation.
Thank you so much.
Been hearing so much about cryptocurrency, been an investor for 30 years. Someone like me, this seems so many moving parts, along with the legal, the regulation,
right,
the technology. When do you think it's going to be safe for someone like me to really invest in this blockchain or this cryptocurrency technology?
Yeah. I mean, it will be safe when you've taken the time to do your own research and understand the moving pieces. And to the extent that more and more infrastructure is rolled out, and it becomes easier and easier for people to not know how the combustion engine works, that might be a different point in time for you. It's very simple to invest now. You can open up a Coinbase account, you can move money across, you can get exposure, but do your own research. You invest when you feel comfortable with the infrastructure. You feel comfortable with the infrastructure and that you understand it. Or when there is an investment advisor out there who you believe, because it's Merrill Lynch or Fidelity or Blackstone or whoever it is, you have faith in them, and that's the point. But people will go into crypto at different times based on the level of understanding that they have of it.
Thank you for that informative speech. Earlier you mentioned that crypto-to-crypto trades are taxable. I'm wondering...
In America.
Could you opine on like-kind exchange? I think it's under 1031.
Yeah.
And whether it's applicable in 2017?
Yeah, it would be a taxable event, and then you would have to get it into an exemption. So to the extent that you're doing a like-kind transaction, there are ways of pulling it into that, but you have to understand that the event is taxable and you need to go into an exemption.
I'm having some difficulty understanding why a person would, quote, invest. And I have the same difficulty in understanding why some people think they can invest in real-world currencies. Because real-world currencies do not have an inherent return. They are simply relative prices.
Wow.
And whether they go up or down depends on the market's perception of where they should go. So you can't say, well, you put your money with me and I'll buy the right currencies. Well, I'll make the right punts and you'll do better because I'm good at making punts. There isn't an inherent return in any currency, if it's
right.
crypto or if it's real world, isn't it? Isn't that the case?
Well, I mean, from a mathematical point of view, you're right. A currency is a very odd investment that decreases in value every year. If you have a $10 bill and that's your investment, currencies decrease in value. You're absolutely right. They don't increase in value. They decrease in value due to inflation. Due to inflation. But what currency does give you is volatility. And if you're a trader, you love volatility. You want some of that volatility. You want all the volatility that they'll put on your plate as you go through the cafeteria line. Give me more of that volatility. And I think the currency markets generally give that sort of level of volatility that a lot of investors like because of cash flows and being able to map what I find under the fiat currency markets, issues that are rising and are influenced by other macroeconomic factors and other corporate issues. So what I would do is look at a particular company or geographic or a company in a geographic and say, well, that my trading thesis allows me to execute it by doing this in currency, this in stocks, this in bonds. There are a lot of different things you can do around it. And maybe Bitcoin isn't a currency. People have been telling us for months and months and months, it's not a currency, it's not a currency, it's not a currency. The very things that make an investment a good investment are bad for currencies. That's true. Currencies shouldn't go up thousands of percentage points a year. And the same things that make a currency good, stable, slightly slightly decreasing in value due to inflation, that makes a great currency, a really great currency. That's a horrible investment. That's like my 401k, a balance that just stays basically the same except it's slightly declining every year due to fees. That's not a great investment.
Hi, John Samuelson. Thank you very much. Very informative. So you spoke about taxable events. Where's the line between that and going online to a website and just buying a bar of soap or some low-end commodity, or is there one?
Right. The basic idea is if you're buying bars of soap for $1 and you're selling them for $10, that's a taxable event.
No. So I mean that I bought a cryptocurrency and I went online just to buy my commodities for my home.
Yeah, the buying of a cryptocurrency, converting $100 of cash into $100 of crypto is not a taxable event. I'm not a tax lawyer, so I'm kind of collapsing a lot of these concepts together. What is a taxable event is for me to buy a signed Michael Jordan jersey for $100 in the 90s. I sell that signed Michael Jordan jersey now for $10,000. I got to pay tax on that. That's just the world we live in. If you buy property at one value, you sell it for a higher value, you've got to go through the analysis of that being a taxable event and what amount of the capital gains you have to put to the IRS. That's, okay. Right. The question is, could you make an argument? What sort of arguments can you make about common enterprise? And I mean, what a common enterprise means we're all in it together. That we all have the same exposure. So when I buy my row of orange trees and go back to Philadelphia, you buy your row of orange trees and you go back to New York, somehow it's all a common enterprise. We don't have individual bilateral relationships. We're somehow pooled. I think there's a lot of potential there to make arguments that we can pull out of the definition of Howey on certain very specific structures. But the SEC, I think, just takes it as read, that everyone who's holding the coin is somehow in a common enterprise with one another. Another question.
Thank you so much. Mr. Timothy, what about the controversial topic right now, artificial intelligence?
Yeah.
We need to be scared about that in this virtual market because we can develop a predictable hybrid system to reduce cost in 0%.
Right.
You know, but what about if the artificial intelligence destroyed this virtual world? What about that?
No, it's a very good question because I'm someone who spends a lot of time looking around corners, looking into the future, and I really see one of the most powerful applications of blockchain being a combination of the blockchain technology that we have now, the Internet of Things, and machine learning, artificial intelligence. Imagine how powerful distributed computing could be. I think we're still a long way away, but look how powerful it can be if we had something like machine learning, something like a artificial intelligence operating on a distributed network, decentralized network. Now, I will say this, and the great example of this is Ethereum. How many people here have heard about the Ethereum World Computer or the Ethereum Virtual Machine? People are familiar with Ethereum. What Bitcoin does is everyone's different computer who's a node on the blockchain is able to keep a copy of the ledger on their node and be able to update it for transactions. So you're sharing your part of your computer in an attempt to maintain a decentralized collection of records. On Ethereum, they're actually taking your computer and running programs on it. They're actually running programs on it. As I like to call, you know, the Ethereum virtual machine is a computer you can't turn off. And a big fan of I am 80s movies, Skynet. Skynet, anyone? Skynet? Is anyone at all worried about this? We've got computers that we can't turn off. We have this decentralized distributed network. We can run programs on it. Maybe one day we're running AI on it. Who knows? We'll make great pets, so I'm not particularly worried about how this all ends up. But I would keep an eye on AI as far as one of the really powerful applications, one of the really powerful use cases of the technology.
You mentioned the utility ICO still being a narrow focus.
Very narrow.
Does it have to be a trade for tech, or can you actually do it like like a coupon or a warrant, like you would normally raise funds? You know, if you actually have a product that you're going to sell or you're going to create, and you can actually give somebody, an investor, here's your fixed term.
That's a security.
Okay, but can you set it up that way within the ICO system and
to be a security? Yeah, it's easy. It's not easy. It's commonly done now to have a securities law compliant ICO. That's not a problem. Just because you say it is a Howey Test security doesn't mean you have to take your ball and go home. You can still do an ICO. You just have to understand that those tokens that you're selling are securities, and you have to have a valid exemption for whatever you're structuring it as a warrant, as a bond, as a fixed income, as a note, as a share or equity, whatever it happens to be. You can still have that offering. You just have to make sure that your only buyers in the United States are accredited investors, or you're otherwise covered by 4A2 or Reg D or Reg A plus or something like that. It being a security is not the end of the analysis. It just means you basically can't do a retail offering, not necessarily of the scale that you envisioned. You'd have to go through one of the established private placement exemptions. Just to get to other questions, sorry.
So Cooley, I believe, did the paper on the SAFT, the SAFT.
Yeah, where's that guy now?
Sorry? Oh, where's that guy?
Where's that guy now? He's not working for Cooley.
Oh, really?
Yes, he is. He moved on to what is it, blockchain.org? Where did he go? Marco Santarelli. Good old Marco.
Well,
yeah.
So the question is, did they get it wrong? Because that's one of the things the SEC is looking at.
If you were asking someone in the SEC, they would say he got it wrong. And I think if you ask any of the partners at Cooley, well, he doesn't work there anymore. So we'll see. I love the analysis. There's a lot, just to shout out props to Marco, wherever he is. A lot of the analysis I actually do believe in. But my opinion doesn't really matter that much. I think what we need to do is understand the issues that the SEC has, the view that they have. They're there to protect widows and orphans. Widows and orphans. And they should. None of us in ICO land, none of us in crypto land, none of us blockchain true believers, no matter how much we're counting down the days to our Lambo, we know it's coming. We've got it on the calendar. We know when our Lambo is going to arrive. We still don't want widows and orphans to get fleeced. That can't be what this is all about. It's just not good for business. So if there are day one frauds, if there are Ponzi schemes, if there are these sorts of things in place, there should be someone going out there and kicking butt and taking names, and there should be people in orange jumpsuits, cuffs, doing the perp walk. That's probably a good thing. I think what we have to do is engage in a dialogue with the SEC. We've got to be transparent with our regulators. We've got to let them understand this is a technological development. If they say don't market your ICOs like that, you know what we should do? We shouldn't market our ICOs like that. If they say you need to do this or you need to do that, we probably should do that. We should be transparent with the SEC. We should engage the SEC. We should let them know that this is a technological development that we're participating in. If you're doing this to get rich quick, you're probably selling a security. If it looks like a duck and walks like a duck and quacks like it's a duck, it's a security. And you're going to go to you're going to end up in an orange jumpsuit. So I don't fault the SEC for taking that position. I do think there are more nuances that hopefully the SEC will get more comfortable with. That will move us back to the Cooley memo, the Cooley Precision Labs memo. But we have to realize the situation that we're in. We absolutely have to realize the situation we're in and the statutory mandate that the SEC has to do what it needs to do.
Hi, I was just wondering if you could circle back to any use cases that you think may be possible with IoT, AI, and blockchain together. Like, do you have specific examples that come to mind?
That's a bit outside, and there's a limit on what I can talk about because of projects I'm involved in. I think if you marry blockchain technology and cryptocurrencies, the Internet of Things, I think, is incredibly powerful. The ability to link up things together. And in my beautiful triangle I gave you before of kind of blockchain and Internet of Things and AI, machine learning, I think there is a function for cryptocurrencies, for digital assets to be able to move around a system. we have to pay for the distributed system to operate. So what I would say is Internet of Things, don't underestimate the power that microtransactions in cryptocurrencies can engage in as a way of making sure that all the various components of the network of things that are on the IoT are operating in a correct way. Being able to transfer little bits of micro value from one point to another point on the network could be extremely powerful as an organizing principle.
Thanks.
I'm going to call it quits, but I'm here all week, and I'm here for the next hour or so, as long as you need me. So come up, and I'm glad to speak to you. Thank you so much. Thank you.